Okay, good afternoon and welcome everybody. My name is Alistair Pym. I'm the VP of Innovation and Partnerships at NECEC, and I'm very happy to welcome you all to the third in our series of 5 webinars on investor and corporate partner readiness. Today we've got a great story about the evolution of CEVG, the leading clean tech angel in this space in the Northeast and probably across the country. And then we've also got a really good story about an investment they made in a clean tech startup, Pika Energy, and we'll hear more about all of that later. We've got a great speaker lineup, and I'll introduce everyone shortly. But first, just let me run through the flow of the day and mention a couple of housekeeping issues. First of all, I hope you can all see the slides through the Zoom. We're not going to share the slides as such, but we are going to record the webinar and then share it on a link to the recording. So you'll get that after the event is over on our YouTube channel. I would like to next thank our sponsors, Massachusetts Clean Energy Center and NYSERDA, the New York State Energy Research Development Authority. They both sponsor us to drive innovation and the acceleration of the clean energy sector in the Northeast. For NECEC, we're the Northeast Clean Energy Council. The Northeast includes all of the 6 states of New England and New York. We've got an extensive network of startups, investors, corporate partners, utilities, customers, and professional service firms. In fact, everything we believe that a clean tech startup needs to help them start and then grow and scale their business in the Northeast. The agenda today is, after my quick remarks here, I'll introduce you to Micah Koch, who is the Managing Director at Urbanus, an incubator in New York. And then we have David Miller from both CVG and CEVF, and I'll let him explain the difference. Followed by Jean-Noel Poirier, who is also a member of CVG in New York. Ben Polito, who is the founder and CEO of Pika Energy. And then we'll open, first of all, Micah will ask the panel a few questions. Then we're going to open it up to all of you on the audience to send Micah questions, and he will pick from those questions and ask the panel those questions. So if you want to ask a question, please send it through chat. You can address it to everyone because Micah's address is very complicated, and Micah will see that. And then we'll just have a quick wrap up at the end. So I think we've covered that part. And then here's some pictures of everyone. I think I mentioned everyone's names, but just a refresher so you see that we are real people. And I would like at this point to hand over to Micah, who is going to moderate today. Micah, thank you very, very much for doing that. And thank you everyone for attending. Over to you, Micah.
Thanks a lot, Alistair. Really great to be working with NECEC again. Super excited about the panel that we have today. And hopefully we'll make this really interactive. So to the extent that you have questions about the new operating model, the plans for CEVG here in New York, or the path that Pika has taken, please use the Zoom group chat, send your messages to everyone. And then after we get through some of the prepared presentations, we'll really make this every attempt to answer the questions that you have about early stage funding and the new model for CEVG here in New York. I think that I know several of you on this webinar through my work at NYSERDA. I'm now at Urbanus, which is a venture accelerator backed by Mini in partnership with Urbanus for startups who are reimagining city life. So while I was previously at NYSERDA working on REV demonstration projects, New York Prize, and clean energy innovation, now the scope is a little bit broader, really kind of looking at the urban ecosystem. You can move to the next slide, please. One of the points that I just wanted to make about the way that we see the evolution of venture activity and innovation here is through this notion of kind of the city as a platform. And I think previously we thought about the city in a very siloed fashion. where you have kind of infrastructure and the built environment and the people who are forced to contend with those investments that we've made and the investments that we haven't made in urban infrastructure. And I think now there really is this new layer of sensors and data and applications that in many cases are being built by entrepreneurs that are breaking down those silos. And we think that that presents not only significant opportunities for wealth creation, but also significant opportunities for carbon reduction as well. Next slide, please. Urbanx is an accelerator program. It's a 5-month program. We invest in 20 teams per year in groups of 10. And our next program begins in April of 2018. Applications are open now through January 31st. We invest $100,000 in each team that we work with. But more than the cash, I think, like most good programs, the real value proposition is in the mentors that we bring to the table, and also in the experts that we also bring to bear to help with things like product development, engineering, design, communications, exposure, user experience, user interface, all those critical things that are really essential and also very expensive for early stage teams. And hopefully we'll hear about some of that process from Pika. What we want to do is to help the teams that we work with ultimately get to Series A and make them investable at a seed level for shops like CEVG. Next slide, please. Just to give you a sense of the space, it's a community that we've built in Greenpoint Brooklyn, which is really kind of the creative center of New York City. The program starts with a formal launch and concludes with a formal demo day, and in between we host a number of programs on things like autonomous vehicles. Connected real estate tends to be a really big emphasis of the program that we run. Next slide, please. Just a quick word on our venture partner. We're working with an entity called Urbanus. They have made over 30 investments in companies like Architizer, Ratio, Seamless Docs, everything from GovTech to energy to mobility to waste. And the fund has had some really nice notable follow-on investments, which again are, I think, a real North Star metric for many early stage and seed investors. Next slide. And with that, should you have any questions about Urbanx, please reach out. If there are companies in your portfolio that are in that pre-seed stage that are looking for cash plus resources, and you think they could be good applicants, you can also refer them at urban-x.com/apply. And with that, I'm going to turn it over to David from Clean Energy Venture Group, and he's going to talk a little bit about the fund, their thesis, and what comes next. David.
All right, great. Thanks, Micah. Appreciate your introduction. And also I'd like to thank Alistair and also Katerina Madera, who helped make this webinar happen in the first place and arrange it and set everything up. So great thanks to them, and also my fellow speakers, Jean-Noel and Ben, who we will hear in a little bit. But what I wanted to do is cover Clean Energy Venture Group, Clean Energy Venture Fund, where we come from, why we exist, and what we look to invest in and how we look to invest. So next slide. So here's some of the motivation, and I think this introductory part, a lot of folks on the call will have seen this before, or at least understand the challenge, in that particularly in clean energy, there's what we call a valley of death. Not a very pleasant term, but there tends to be gaps in the funding life cycle where, very early on in the development of research, R&D, state, maybe formerly federal, but more and more state government and industry supports R&D, which generates ideas that can be commercialized. And those ideas can be brought to the early stages of commercialization, and Urbanus is one example of many of great accelerators that can help do that. And then later on in the life cycle, once a company is growing, traditional venture capital can often step in, and a company has established customers in markets and is growing quickly and has significant revenue. That's where kind of growth stage venture capital likes to step in, but there's a gap in between, and incubators fill that to some degree, but I think, as a lot of folks in this industry know, there's much more demand than there is supply. So if we go to the next slide, if we go back in time a little bit to maybe 10 years ago, 10 years ago, there was actually a fair amount of money in clean energy. And you had your traditional venture firms, Kleiner Perkins, Khosla, NEA, that had raised very large funds in, approaching, billions of dollars, and were funding across the life cycle. And we're looking to deploy quite a bit of capital through the life cycle of clean energy. And that it created a little bit of a bubble. And there was a lot of capital deployed in companies that weren't necessarily venture plays as well. And that ended up not working out. There were manufacturing plays and so forth that were competing with Chinese manufacturing that absorbed a lot of capital that, those models did not work, even though they were enticing at the time. So if we go to the next slide, what happened is a lot of those funders, especially since they weren't successful, they pulled out, particularly of the early stage, and particularly in clean energy. And so there were still clean energy investors left, but many of them really focused more on the growth stage, that stage where companies have already proven themselves, where they already have significant revenue, where they've demonstrated significant revenue growth. But that stage before, the early stage, it left a gap. And what we see now, and folks, I believe folks on this webinar will either have been sent or will be sent a link to a paper that we wrote alongside Series that explains this a little further, is we're in a situation now where there's fantastic support for research and bringing research to the possibility of commercialization. And again, accelerators like we just heard on Readiness, and there's MIT Engine, which is a new effort here in Cambridge, and NYSERDA, of course, supports tremendous programs along these lines, as well as NECEC, number of efforts on the West Coast as well. There's a group called Prime that supports early stage clean energy efforts. So there's great support for research that's very promising, and bringing that research to the very early stages of commercialization. And there's great support now for companies that are in that growth stage. But that gap in between is really been vacant for the most part. And there are some groups on the West Coast that intersect clean energy that are listed here. But as far as investors who focus on clean energy in the early stage, we looked around and we really couldn't find anyone who would do that, especially in the eastern half of the country. There's just a tremendous void. And so that's where we look to step in. So if we go to the next slide, another kind of demonstration of the need here, and again, I think folks would understand this, is we're seeing tons of technology being developed, really promising technology in this market, and this is just a proxy based on patent growth. But at the same time, particularly over the last 5 years, we've really seen a diminishing number of venture clean energy, clean tech seed rounds, that early stage of commercialization. Again, kind of a really direct demonstration of that gap. So we'll go to the next slide. One other example of what's going on in the market and the need is, and again, I think this is a story most of the folks on this call probably know, is that, we're kind of entering this exponential curve. And more than entering, we've been in this exponential curve for a while of adoption of clean energy, and wind and PV and energy efficient lighting are proxies for that. But you see that across the board for clean energy technologies, carbon-free energy production and all forms of energy efficiency, that, the world is really woken up to these technologies and is adopting them at an exponentially increasing rate. So go to the next slide. Our mission, so CVG started in 2005, and our mission from the beginning was to invest in and to support these early stage clean energy companies, and specifically companies that have the potential to mitigate climate change. And, obviously as they're just starting out, that might not be the case, but there has to be the ability of the company to scale to the point where it will have a global impact on greenhouse gas emissions related either to the production of energy or the use of energy, if energy efficiency. And the way we do that is in collaboration with entrepreneurs. We in our group are almost entirely all former entrepreneurs. So we've all had the experience of starting and running companies. And so our model is very collaborative. How do we work with entrepreneurs to develop clean energy enterprises? So go to the next slide. So a few statistics about our group. So we started in 2005 with 4 partners at the time. Again, kind of all entrepreneurs looking to support clean energy enterprises. And since 2005, we've now grown to 22 active members, 5 of whom are in New York. And Jean-Noel will talk a little bit specifically about the New York effort. In that time, we've invested in 32 companies, well over 100 rounds of investment in those companies, comprising approximately 17 million from us and from capital we've managed through special purpose vehicles. But importantly, once we've invested in companies, we've been followed on, and Micah mentioned this, by over $500 million of institutional capital, strategic investors, traditional venture capital firms, family offices, and so forth, have followed on into our companies to support their further growth. And so, what we're finding is the companies that we're investing, we are enabling them to grow. And initially, when we started the group in 2005, investing out of our own pockets, we weren't putting in a lot of capital. Maybe $50,000 investment, maybe $100,000 investment. But we were putting in a lot of time, and we were mentoring these companies and helping them get to that next stage and helping them raise their next round of capital. And for the most part, we've been successful with that in bringing in additional investors and enabling these companies to grow. So if we go to the next slide, here's just a sampling of companies that we've invested in over that period of time. And you may recognize some of these, you may not recognize some of these, and I could probably spend an hour talking about each one. It's like your children. I mean, these are all great companies, great stories. I can't say we've had 100% success rate. That doesn't happen in seed stage investing. But out of those 32 companies, we've really only lost a few, maybe 4 or 5 out of the 32. And the vast majority of the others have continued to grow, are succeeding. Of course, a number of companies have already been acquired, and many of them are on that path. So if we go to the next slide. So what is CEVF, Clean Energy Venture Fund? So what happened with CVG is, as I was explaining, over the last 5 years, really other investors left the early stage space. And we as an angel group were investing out of our own pockets. So we couldn't nearly meet the demand of capital required for companies coming into this space. And what we started doing a little over 3 years ago is creating special purpose vehicles. When companies that we were involved with were raising capital, we would go out to third-party investors, family offices primarily, raise capital for those particular rounds, and then put those rounds together. And that worked as an interim strategy. Problem was, it wasn't very efficient because we were raising capital on a round-by-round basis. It's very time-consuming. So what we decided to do is to raise committed capital. And we've now closed on a fund, a traditional venture capital fund, 10-year life, 5-year investment period. We are raising a total of $100 million. We've closed on 38 million so far. We have about another 25 million committed. And so we have about another 38 million that we're going to raise. And that's going to enable us to invest in the next 25 companies. And to do so in such a way that, you know, we can come in and lead that initial round of capital, kind of bring our expertise to how do you put a round together, develop a syndicate, invest as a fund in conjunction with the angel group, because CEVG as the angel group is continuing to grow and to thrive. And again, Jean-Noel will talk about the New York branch of CEVG. But now the fund has the heft to guarantee a significant investment in that seed round and also to follow on into the companies. And further than that, and I'll talk a little bit more about this later, is the strategic investors of the fund, the limited partners of the fund, are entities that are very large entities that are willing and really looking to invest in those later growth rounds. So it creates another one of those multiplying effects. And CEVF's strategy is very akin to CVG's. It's really CVG with a lot more capital, and it's very hands-on. It's going into the companies, playing a very significant role in helping them grow, and helping those companies be financed and helping them develop their business models and strategy. And it's leveraged by 13 members of CEVG who are also venture partners in the fund. And so are part of the fund in addition to the 3 principals. So the fund has 16 partners, which enables us to take that very hands-on approach. So if we go to the next slide, you know, and here it's talking a little bit about our focus on mentoring and helping to manage the companies that we invest in. And in fact, that's one of our very important investment criteria is we look to companies where we can add a lot of value. And if it's a fantastic company that looks like it has great prospects, but we don't see how we could help them, then that's less of a investment prospect for us. So kind of mentoring, advising companies is very important to us. It's something that we do for a lot of companies, that our individual members do for a lot of companies beyond those that we invest in. Kind of happens organically through the ecosystem. Our members have helped develop the Northeast Clean Energy Council. We worked quite a bit with Mass CEC. Our New York members work very closely with NYSERDA. We have a very strong connection with Urban Future Lab, with Greentown Lab. So it's really a very strong partnership model. It's an ecosystem. And we really try and help that ecosystem as much as we can to help companies be created and get to that next stage. Let's go to the next slide. So what do we look for? And this is something that I would imagine folks on the call would be particularly interested in. Well, to start, you know, we look for what all other venture capital investors look for. We look for the best teams in the world. And that's absolutely a focus of ours. We spend a lot of time on diligence in that process of looking at, you know, is this the right team? You know, how can the team be improved? How is the team going to develop over time? How can we work with the team? That's absolutely key, first and foremost. Of course, we're also looking for companies that have a sustainable competitive advantage, addressing a significant market opportunity. And can grow and scale relatively quickly without requiring a significant amount of capital. We're a seed stage investor. We're really looking to kind of efficiently deploy the capital. And we're looking for somewhere in a 3 to 7 year investment life cycle. And again, I mentioned we're looking where we can add value. Specifically related to clean energy, and I mentioned, capital efficient, because one thing folks, there's a sense of that clean energy businesses are necessarily capital intensive, and that's not the case usually. You can really often modify business models to be more capital efficient, even if you're working on hardware, even if you're looking at hardware that might be large scale, deployed on a large scale. Obviously, we're looking for disruptive technology. Talked about that it has to scale. We're looking for companies that their product or service is not a commodity. There's some differentiation about it. We don't take policy risk, so it can't be something that's dependent on some policy passing. So for example, in the last presidential election, when we looked through our portfolio and thought about, is this going to have an effect on our portfolio? It really didn't, because none of the companies that we had invested in were really depending on whether it was going to be a Democratic or Republican administration. And also, I've mentioned we're looking for companies that have potential to mitigate climate change as they scale. And in conjunction with that, also return a large multiple on our investment. And we see those two of those as inextricably linked. It's not one versus the other, it's an and. If the company is going to scale capital efficiently, address a market need, then that scale is going to enable them to both mitigate climate change and return a large multiple. And then we have examples of both disruptive technologies and disruptive business models that are examples of things that we invest in. So if we can go to the next slide. So here's a little bit about our process, to give folks a sense of what we do, how we do it. So we see on the order of 100, it's probably more than that now, that we're investing through both the fund and the group, probably more than 100 companies per quarter. And that really requires us to do a fair amount of filtering, because there are quite a few companies that we see that, again, might have great promise, but we might not be able to add value to them. Or it might be a company that isn't going to scale in the time frame we need, or it might require too much capital, or maybe it might not require enough capital to require a venture investment. So there's a fair amount of filtering that we need to do. And it comes down to maybe 12 companies a quarter where we actually will talk to the company, maybe initially have a conference call or a quick meeting, and kind of better understand what they're looking for and whether there's a good match with us. And then after that, we'll often invite a company, if there is a good match, we'll invite them to come in and pitch to us in person as a group, the entire partnership, which may be 10 to 20 of our partners. And that's a very interactive session. At that point, we have a little bit of an understanding of the company. They have a little bit of understanding of us. So it's not a one-way thing. It's a conversation that we as a partnership have with the company. And that enables us to decide whether it makes sense to go into a deep diligence process. And then once we get into a deep diligence process, then we fully engage and we look very heavily at the market the company is addressing, customers, scale, competition, team, of course. And again, we're trying to answer all the questions we talked about in our investment criteria. How can we help this company? Can this company scale? Is this company going to make a difference on climate? Is there a good exit here? Is there a good investment return here? And we do our best to answer those questions. And if those questions are positive, then we start finalizing terms and moving into an investment. And like I said, we've done well over 100 rounds of capital, so we've done this many times over. Next slide. So I'll talk quickly a couple of case studies. So Ben from Pika is on the line, and he's an example of a great company. Pika is an example of a great company, and Ben is an example of a great entrepreneur that we invested in. So you'll really hear kind of a more full case study with respect to Pika. But I'll give just a couple of quick other ones. So My Energy is a company that we invested in 2011, and this was originally out of the Angel Group. It was a software company. It scraped utility websites and then used that information to motivate behavioral energy efficiency at a very high rate. So it really kind of met our criteria in that it could have a very large impact. It could motivate energy savings on the order of 10% across very large numbers of users. And it could do that very capital efficiently. So we made an investment as part of a syndicate, as we usually do. There was a strategic investor and a financial investor. We took a board role, helped the company in those initial stages. And then 2 years later, as the company was looking to develop strategic relationships, that classic question came up of, why don't we acquire you? And Nest Labs at the time, they would talk about energy efficiency, but their thermostats didn't have a sense of the overall energy use of homes. And so My Energy's technology was extremely helpful to them. And Nest acquired My Energy. Essentially, we as investors exchanged our My Energy shares for Nest Labs shares, and then Google acquired Nest Labs 1 year after that. So that's an example of a relatively short turnaround for us as investors, 3 years from investment to exit. And it's also an example of how a company can really only raise one round of capital, and yet still have a significant impact and have a very relatively on in the life cycle. And I see the deck has gone away, but I will continue and presume that it can come back on. So this company, we met the technical founder relatively early on in the life cycle, and really helped the founder develop a business model. We actually helped name the company. Originally, it was focused on using solar thermal energy to power very efficient AC. What we realized is though that was very cool, the solar thermal aspect wasn't necessarily unique. The extremely efficient air conditioning technology was. So we helped motivate the change of the name from 7 Solar to 7 AC. We funded an engineering study to provide evidence of whether this technology would be as efficient as it promised, and the engineering study was successful. And then that motivated additional rounds of capital. And one of the initial rounds came through the Mass Clean Energy Center. So again, kind of a state entity playing a significant role in the ecosystem. And then every round of capital after that has come from strategic investors. 3M, and then Sabic, and then Emerson. And again, this company is a company that can change the world by making air conditioning 50 to 90% more efficient. But they're not going to do it by themselves. A startup is not going to change the global air conditioning mix, but working with strategic partners, they can. And so they've developed those relationships that are very strong, and we see the potential going forward as the company works more closely with those partners, of the technology being scaled very significantly. And these partnerships already comprise of potential in Asia, in the Middle East, and North America and Europe as well. So we're seeing very, very significant impact from what began as really just a good idea. If we go to the next slide. I talked a little bit about strategic investors. That's really key. A lot of strategic investors have invested in our companies, and strategic investors are now beginning to invest in our fund, which will give them actually even a closer link to our portfolio and give them privileged ability to invest in follow-on rounds of our portfolio. And so once again, that's a really important part of the ecosystem. That's the other side of the equation of, where do the companies go and how do you help those companies scale? So I think I'll finish there. The next slide is just our contact information. The fund is based in Boston. The Clean Energy Venture Group is based in Cambridge. Both entities, as I said, work very closely together. We share a pipeline management system. And so companies that wish for us to kind of consider them as investment opportunities, if you go to either website, but if you go to CEVF.com, you will see a red button that says submit your company info. And those are the 10 questions that we ask every potential company coming to us. Gives us a sense of where the company is coming from and helps us ascertain how we can best help them and who in the group is best suited kind of for that initial screening call. So if you're interested in us looking to as a company, I'd highly recommend going to our website, filling in that form, and that enables us to follow through. So I will now turn over to Jean-Noel, who will talk a little bit about what CVG New York is.
Yeah, thanks, Dave, and thanks everybody for attending. So, CVG New York is an extension of CVG Boston. So, obviously everything that Dave described applies to New York as it relates to CVG. The spirit, the goals, the process are basically the same. The group in New York has assembled a few months ago. So we are right now a smaller group, about just 6 members so far. Very active though. Everybody has a clean tech background, a clean tech focus, whether as a investor, as an operator, or past entrepreneur. And the group of people that constitutes the group in New York, has been active in the ecosystem for a very long time as mentors, investors, entrepreneurs, residents, etc. So basically here we're teaming up and working as a group, coordinating with the group in Boston, which makes us much more effective, and we can benefit from the assets built and the capabilities based and built in Boston, which is my second bullet. Basically, if you talk to us in New York, you're talking to CVG as a whole. The difference is we are based in New York. So if you are a company based in New York, you have some people to talk to. We can meet easily. We're based in New York City. And so we can be your first connection if you want to the group. But when you talk to us in New York, you basically talk to everyone in CVG, which means that we have the 6 of us, and we are active, but we have access to the group in Boston for funding and support, both the angel group, but also the fund now, as described by Dave. So we can do follow-up investments through the fund. So I think it's a very interesting setup. Talking about New York, we have a partnership with NYSERDA, which has been the case as individuals for a long time. But NYSERDA is very supportive. We have the same goal. Basically, what we're trying to do here really is helpful and important in supporting clean tech in New York. They've explained there's a gap in funding, and we're filling that gap, not just in funding, but also in mentoring. So we're really well aligned with NYSERDA, also with NECEC, by the way. And we intend to, be your point of contact, be a support system here. And we will actively connect with companies in New York in the next few months Actually, the slide here states the New York State, which is important. It's not just New York City. We're based in New York City, but we really want to be active throughout New York State. So we will, connect, reach out, and welcoming inquiries from companies, incubators, and everybody in New York. Actually, we will, just for information, we will do a road trip with a few of us the week of January 22 to 26, and we will visit Albany, Rochester, etc., all the incubator universities, accelerators, and we are welcoming face-to-face meetings with people based outside of New York City. So we're going to do that early January, so we are well connected and ready to consider interesting companies and projects early in 2018. So that's what we're going to do. That's just my contact information. I'm going to act very actively as the liaison, if you want, starting in January for the rest of the group. Feel free to reach out to me directly by email. You've got my cell phone as well. And so, feel free to reach out again, and we'll, from there, take it through the process, maybe have meetings in New York, and then hook you up to the larger system and pipeline management system in Boston. And so that's it. I'll turn it to Ben. Ben?
All right. Yes, I will unmute myself. Hello, everyone. So I'm here representing, I guess, a case study of how all this can come together and become real. I'm a co-founder, together with a classmate from MIT, of Pika Energy. We're a power electronics developer and manufacturer. Our company's mission is to deliver cost-effective clean power on demand, combining solar and batteries using our patented platform, which we call Rebus. So we are a mission-focused group. We believe that accelerating the transition from dirty fossil energy to clean distributed power is the most critical challenge facing modern civilization. So that's a huge subject. I'll try to be quick though, because we're running short of time. So the good news in that, if that's your mission, the good news is the building blocks are falling into place. I think one of Dave's slides showed that over 60% of the new capacity is clean. But the problem, if we flip to the next slide, is that the clean energy sources, the new and rapidly scaling clean energy sources, of course, are intermittent. And intermittent power is painful for everyone. If you look at the top of this image, if you're in this space, you're probably familiar with this. Is the famous duck curve, showing basically a day in the life of the grid in California. So the yellow and the darker yellow represent solar. So you see that at noon, solar represents 50% or more of the electricity that's running the state of California, and then it's all gone by bedtime. So that's a pretty absurd situation, really. You see that economically at the bottom. This is the price, the sort of spot price of electricity. So you see that the spot price of electricity is actually negative in California when the sun is shining these days. That's kind of a bad thing if you want to see solar continue to grow. And so you can nibble around at this by changing behavior, by sort of encouraging people to fiddle with their thermostats. But to solve it at scale, we need to store that energy in the middle of the day and deliver it whenever people need it. So we go on to the next slide. This is kind of a juicy area to be working in. This market is really growing fast. A lot of things are driving that. Basically, net metering the policy of net metering built the distributed solar energy industry, and it's grossly unsustainable. So you're starting to see that in a bunch of ways. You're seeing time of use billing in California. You're seeing basically end of net metering in Hawaii. You're seeing demand charges being ratcheted up, even in some places on residential customers. there is still, fortunately, some support and at state and federal levels for this to get off the ground, and utilities are rapidly increasing their interest. The market is growing basically across the board, utility, non-residential, commercial, residential, et cetera. So it's pretty awesome. The building blocks, the solar and the batteries are getting much more affordable. What we realized as Pika is that it's the connective tissue, the power electronics and the controls that were the missing pieces. So the problem that you see out in the world is that the solutions that are actually available don't have the characteristics that would enable them to scale rapidly and be adopted. So you see things like solar and batteries as their own sort of separate silos rather than a platform connecting them both seamlessly. As a result, you have multiple inverter systems. Of course, if you look at it from a technology perspective, solar and batteries are both fundamentally direct current components, but they're connected using alternating current. So in the end, you take 3 trips through the inverter. You have extra layers of controls. The solutions are challenging to install. And at the end of the day, you have an expensive system with limited performance. So if we go to the next slide, Pika as a company, we basically overcome these limitations with a clean sheet approach. We actually developed a platform from the bottom up, designed for this type of application. The platform we call Rebus. The core technology is basically a DC nanogrid, a 380 volt DC nanogrid that automatically manages the flow of power between the sources, the battery storage, the loads, and the grid. So the solution becomes plug and play. If you're looking for a good metaphor, USB for clean power does a pretty good job. Similar to USB, Rebus has automatic discovery and configuration. There's power and data on the same wires, and the net results have become simple enough that even someone with average skill in the installation labor world can do the job. So as a company, there's been some twists and turns along the way. We began in 2010 in my basement applying this core technology to solar wind hybrid systems, and we sort of read the market writing on the wall. We refocused on solar battery hybrid systems. We also expected along the way that the battery part would be developed by others and become available on the market. And as things evolved, we actually ended up partnering with Panasonic and combining their battery technology with our power electronics to develop the Harbor smart battery product that you see in the middle here. This is a product we're really excited about. It's part of our Energy Island solution. You can check it out on our website. But the Harbor battery combined with our Energy Island system has superior both energy storage capacity and power ratings compared to products from other somewhat more well-known manufacturers. And the Rebus technology makes it substantially faster and dramatically easier to install and configure. For instance, one installer can add a smart battery to a Rebus system in 1 hour, well under 1 hour actually, which is pretty revolutionary. So we go to the next slide. Again, trying to work through this quickly in terms of where we are as a company. We're growing pretty fast. As I said, we started in my basement with a small amount of founder cash and a huge amount of sweat equity. We took advantage of our local version of the communities that have been discussed earlier here. We were involved in a local Maine. We're based in Portland, Maine, north of Boston. We were involved in a local incubator. We had support from something called the Maine Technology Institute, which is our state's version of Mass CEC or NYSERDA. We were also involved in the Cleantech Open, and that's where we met a lot of the NECEC folks. We had support from SBIR and DOE NREL. Had a seed round from local angel groups, raised Series A from CEVG and other regional venture folks, and a total of about $10 million into the company at this point, of which 2/3 is private, 1/3 is non-dilutive. And at this point, our the name of the game for us is scaling up. We're about 25 people at this point, and working with Panasonic has really vaulted us into a new level. We're accelerated into some of the top distributors in the country. There's another whole other side reflected in the upper left here, selling Rebus core components to partners who are building their own systems, and we're lining up on Series B. So with that, we have 10 minutes left, and hopefully we have time for a few questions. Last slide here. This guy is a Pika. You can look him up on the web, but basically it's an extremely cute furry little critter whose habitat is threatened by climate change. So we're doing it for the Pika and for all of us. Thanks.
Okay. Thank you. So just a follow-up question here. Maybe you can share a little bit about kind of your experience in the process. What's been the most challenging part? You mentioned some twists and turns, but in terms of fundraising, what's been the biggest challenge for you guys at Pika so far?
Definitely a level of trust that comes from that, and I guess mentorship. Finding good mentors and listening is really, as we've found, is the best way to overcome the challenges of fundraising.
And how long was it from your first interaction with CEVG until they wound up as an investor on your cap table?
I certainly over a year. I guess it's sort of CEVG is a little different in a really cool way because there's so many of them and they're just everywhere. And so I think we met Deb Kemper and a few other people associated with Cleantech Open, and just knew that they were out there, while we were, before we had raised any equity. But it definitely being out there early makes a huge difference.
Yeah, great. John Noel, go ahead. Sorry.
I'll just expand on that because I had seen Ben present. I'd say it was at least like 3 or 4 years before we invested, and remember being very impressed in Ben. And the business was much more nascent then, so wasn't really ready for us to invest at the time. But as Ben says, just developing relationship and us getting to know him and him getting to know various members in the group over time. So we have lots of examples of companies that we've seen over periods of years before we've invested. And our last investment, it was 6 weeks from our initial meeting to closing the investment. So it can be quite a bit of variance there.
David, will you normally take a board seat when you make an investment?
We pretty much always will. In fact, that's one of the strategies. And in fact, we actually look to take multiple board roles. Often, one board seat, one observer role. And that's really an extension of our desire to be very hands-on and to be as much value added as we can.
Right. And what's the average check size that you anticipate for the new fund?
So for a seed round, order of magnitude 500K. We can invest less than that. We can invest more than that. But that's, we generally expect to see round sizes in the, kind of 1 to 2 million range. So if we're half of the round, that sounds about right.
Mm-hmm.
and then we reserve capital for follow-on rounds.
Right. There's a question around the IRR for the My Energy investment vis-a-vis Nest and Google.
So I'm not sure if that has been made public, and so if it has not been made public, I won't be the one to do it, but it was very positive. The investors were very happy, the entrepreneurs were very happy. And it was a relatively short-term investment, which tends to increase IRRs.
Mm-hmm. And in terms of the follow-on investment and syndicates, will you actively help your portfolio companies to fill out the round and build a syndicate?
Yeah. I mean, that's certainly one of the things that we look to do. We help to, we like to introduce our portfolio companies to potential funders down the road. We spend a lot of time developing relationships throughout the ecosystem.
Yeah.
And again, making sure that there's the right matches.
Yep. There's a question that came in on the chat about non-dilutive capital and how much non-dilutive capital is common before getting to a pre-seed investment. And I know that's a kind of a gross generalization, and it's hard to bundle both hardware and software companies together in that. I'm curious to know if you have a perspective on that. Maybe even before you do, you mentioned capital efficiency. Can you define how you think about capital efficient investments?
Well, I mean, I can start off with a number. So one of the things we look at is how much capital is this company going to require over the entire lifetime of our investment, from the time we go in to the time that there's a full exit and liquidation of our investment. And, we generally don't want that to be much more than, let's say, 30 million total. Maybe in extraordinary cases, 50 million, certainly not 100 million, not 200 million. So that's, just as a gauge of how much capital is this company going to need to raise, while we are investors. And if they need to raise 25 million, that's something that, we feel we can help support. If they need to raise 250 million, that's probably not for us.
Got it.
And so, the question is if you have a business model, does that business model, does that support, are you going to build your own manufacturing plant, or are you going to outsource manufacturing, for example? Are you going to try and manufacture millions of widgets, or are you going to license the ability to manufacture widgets to someone who already has that scale?
Right. So a question for, I guess, you and John Noel. How much has new policy in New York impacted your decision to have a presence here? And what are the kinds of things that you're seeing that you're most excited about from a vertical perspective?
So, Dave, you want to start, or? I would say, so if you want me to start in New York, Jean-Noël, so I think what we see that's exciting is there is really motivation from New York State, basically, to help clean tech, to help innovation. There are lots of great technologies that don't see the light, meaning they don't make it to market, etc. And the state of New York is really committed to make this happen and helping. And so, and that goes across verticals, across, the category, really. It's not just solar or wind or anything. It's really across the board. So we are very excited by the support we get from NYSERDA. They open their doors to, their ecosystem. So because they see that we are well aligned with them in terms of goals. They also have been very active in non-dilutive funding. So they've given a lot of grants. They are very really supporting the ecosystem. So I think personally that New York is a great ground for clean tech companies, and there was a need for a funding mechanism coming from personal, private investors that bring both money
So thank you, Jean-Noel. This is Alistair back again. I think we're going to have to wrap now. It's 5 o'clock. So I just want to say thank you to all of the speakers, to Dave and Jean-Noel and Ben. And thank you to Micah for moderating and asking some great questions. Thank you to all of the attendees, because we wouldn't do it without you. And thank you for your questions. And again, thank you to our sponsors, NECEC and NYSERDA. We heard great stories about how they've been great partners, and especially NYSERDA in New York. So great to see the ecosystem in action. Great to hear some really interesting new things being launched. Thank you, CVG. And we wish you luck with your fund. And really good to hear the case study of Pika Energy. And we wish you lots of luck, Ben. So thanks again, everyone. Look forward to you joining us tomorrow. I think we've got 2 more webinars coming up this week, one tomorrow at 1:30 on early stage investment models. And we got a couple of investors pitching, and that's at ACRE as well as being broadcast. And on Friday, we have number 5, and I can't remember the time, but it's going to be great. Thank you for joining us. Look forward to seeing you again. Thank you, everyone.
Thanks.
All right, thanks, Alistair.
Bye.
Cheers.
Thank you. Bye.